The stock market keeps hitting new highs. Home prices are still near record levels. And if you add up America's net worth on paper, this is one of the richest moments in U.S. history. And yet, people feel worse about the economy than they did during recessions, financial crises, even pandemic lockdowns. Here's what makes that even stranger. At the same time retirement accounts reached record highs, a record number of Americans were also withdrawing money from their 401ks early and paying penalties just to make ends meet. So, what's going on? There's a pipe in this system that most people never see. The money is flowing, but it's not flowing to the same place for everyone. Once you see where the gains actually go, the disconnect stops being confusing. Here's the part almost nobody says out loud. The economy can be booming while your finances get worse. Both can be true, because when headlines celebrate the economy, they're usually talking about asset prices, stocks, real estate, and rising net worth. But those gains don't magically reach everyone. They go to the people who own the assets, and that's where the story changes. There are about 134 million households in the United States. According to Federal Reserve data, the top 1% own more than half of all stocks. Expand that to the top 10%, and they own roughly 87% of the entire market. That leaves the bottom 90% sharing just 13%. Go even further down, and the picture becomes even more uneven. The bottom half of Americans own around 1% of the stock market. Not 1% each, 1% combined. Now, someone usually says, but most people have a 401k. That's true. But owning some stocks isn't the same as owning enough for market gains to change your life. When the market has a strong year, millions of families might see a gain of a couple $1,000s. For wealthy households, that same market can add nearly 6 figures without working an extra hour. Same market, same return, completely different outcome. That's why record highs don't feel like a national celebration. For millions of Americans, the boom isn't happening to them. It's happening around them. Now watch what happens when we leave Wall Street and look at Main Street. Most people don't live off investments. They live off paychecks. You've probably heard wages are rising, but if prices rise just as fast, or even faster, that raise disappears before it ever improves your life. In the data from the original transcript, wages were up about 3.6% over the year. Inflation was around 3.8%. That means purchasing power actually slipped. And after years of higher prices, it's no surprise that surveys consistently show the cost of living as Americans' biggest financial concern. So here's the obvious question. If households are struggling, why is consumer spending still rising? The answer isn't higher income, it's borrowing from the future. Americans now carry around $1.25 trillion in credit card debt, with average interest rates above 20%. At the same time, buy now, pay later has expanded far beyond furniture and electronics. Many people now use it for groceries and everyday necessities. Whether it's a credit card or an installment plan, the pattern is the same. Today's expenses are increasingly being paid with tomorrow's income, and that's where the risk grows. The longer that debt stays around, the more expensive simply getting by becomes. But there's one number that's even more revealing: savings. The personal savings rate has fallen sharply, and for many lower-income households, savings aren't just shrinking, they're negative. That means they're spending more than they earn after taxes every single month and filling the gap with debt, payment plans, or whatever cash they can access. Which brings us back to those retirement accounts. On paper, average 401k balances have reached record highs. That sounds like great news. Except a record number of people are also taking hardship withdrawals and paying penalties just to access their own money. Many aren't withdrawing to invest somewhere else. They're trying to avoid eviction, pay medical bills, or cover tuition. That's not financial planning, that's financial survival. So the mystery isn't really a mystery anymore. You're looking at two different economies. One is the asset economy. Stocks rise, home values climb, net worth grows. The other is the paycheck economy. Raises struggle to keep up with prices. Debt replaces savings. Retirement accounts become emergency funds. Same country, different experiences. Instead of thinking about the economy as one line, imagine 3 lanes on the same highway. The first lane belongs to households whose wealth comes from appreciating assets. The third lane belongs to households fighting rising costs, with shrinking savings and growing debt. And in the middle are families quietly slipping backward, cutting spending, trading down to cheaper stores, and hoping next month is easier than this one. Remember the question we started with? How can the economy economy looks so strong while so many people feel like they're falling behind? The answer isn't that one side is right and the other is wrong. It's that they're describing different parts of the same economy. So the next time you hear someone say, "The economy is doing great," ask one simple question: great for who? Because once you follow where the money actually goes, the contradiction disappears. It's not one economy, it's different economies sharing the same headlines. And I'm curious, which lane feels closest to your experience? Let me know in the comments.